Hi, and welcome back. In this lecture, we will go through part one of the liquidity ratios, where we will walk through the current ratio. On this slide, we will calculate the current ratio for Amazon. So what is the current ratio and why is it important? Well, to start, the current ratio compares all of a company's current assets to its current liabilities. This metric is also known as the working capital ratio, which tells us about the company's ability to cover its short-term debt with its current assets. Generally, we would want a company to have a current ratio above 1, which indicates that the current assets are at least equal to the value of its current liabilities. So how is this ratio calculated? The current ratio is calculated as the current assets divided by the company's current liabilities. For Amazon, we would start with the current assets value of about $96.3 billion. Then we would find the current liabilities of $87.8 billion. And when we divide those numbers, we get a ratio of 1.10. So what does this mean? Well, we can see that Amazon has a current ratio of 1.10 for fiscal 2019. In other words, this means that for every $1 of current liabilities, Amazon has $1.10 of current assets. Overall, this is sufficient since Amazon's current ratio is above 1. On the next slide, we will now calculate the current ratio for Walmart. First, we would start with its current assets of $61.8 billion. Then we would find the current liabilities of $77.8 billion. When we divide those numbers, we get a current ratio of 0.79. So what does this mean and how is it compared to Amazon? Well, this means that for every $1 of current liabilities, Walmart only has 79 cents of current assets. This is not great since we would typically want a current ratio above 1, as we mentioned earlier on the last slide. So in summary, Amazon has a better current ratio than Walmart for this metric. Hi, welcome back. In this lecture, we will go through part 2 of the liquidity ratios, where we will walk through the cash ratio. On this slide, we will calculate the cash ratio for Amazon. So what is the cash ratio and why is it important? The cash ratio is a liquidity measure that shows us a company's ability to cover its short-term obligations using only its cash and near cash liquid securities balance. A key point here is that when we compare this to the current ratio, we notice that the cash ratio is more conservative than other liquidity ratios. This is because the cash ratio only considers the company's most liquid resources. So how is this ratio calculated? The cash ratio is calculated as the total of cash, cash equivalents, and marketable securities divided by the company's current liabilities. Here, we can see that Amazon has cash and cash equivalents of $36.1 billion. We can see that it has marketable securities of $18.9 billion. And we can also find that it has current liabilities of $87.8 billion. When we take these values, we get a metric of 0.63. So what does this mean? Well, this tells us that Amazon has a cash ratio of 0.63, which means that for every $1 of current liabilities, Amazon has 63 cents of liquid resources to cover that liability. On this slide, we will now calculate the cash ratio for Walmart. Using the same formula, first, we'll find cash and cash equivalents of $9.5 billion. We'll notice that Walmart does not have marketable securities on its balance sheet. And then we find its current liabilities of $77.8 billion. When we take in those amounts, we come up with a cash ratio of 0.12. So now, what does this mean and how does it compare to Amazon? Well, this tells us that Amazon only has 12 cents of liquid resources to cover every $1 of current liabilities. In other words, Walmart does not have a large cash balance on hand when we compare it to the current liabilities on its books. So overall, when we compare Walmart to Amazon, we can see that Amazon has a much healthier cash ratio than Walmart. Hi, and welcome back. In this lecture, we will go through part 3 of the liquidity ratios, where we will walk through the quick ratio. On this slide, we will now calculate the quick ratio for Amazon. So what is the quick ratio and why is it important? The quick ratio tells us the company's ability to pay its current liabilities without needing to sell its inventory. Similar to the cash ratio, the quick ratio is a more conservative metric than the current ratio since it excludes inventory. The key point here is that a higher quick ratio means that the company is financially stronger and more liquid. So how is this ratio calculated? The quick ratio is calculated as the total of the company's cash and cash equivalents plus marketable securities plus accounts receivable divided by the company's current total liabilities. For Amazon, we have cash and cash equivalents of $36.1 billion. We have a marketable securities balance of $18.9 billion. And we have an accounts receivable balance of $20.8 billion. We then find its current liabilities of $87.8 billion. When we take these amounts, we come up with a quick ratio of 0.86. So what does this mean? Well, this tells us that without having to sell its inventory balance, Amazon would still be able to cover 86% of the current liabilities on its books. On this slide, we will now calculate the quick ratio for Walmart. Using the same formula, we'll start by taking its cash and cash equivalents balance of $9.5 billion. There are no marketable securities. We find its accounts receivable balance of $6.3 billion and its prepaid and other balance of $1.6 billion. We then locate its current liabilities of $77.8 billion at the bottom of the slide. When we take these amounts, we come up with a quick ratio of 0.22. So what does this mean and how does it compare to Amazon? Well, this tells us that without having to sell its inventory balance, Walmart would only be able to cover 20% of the current liabilities balance on its books. We can see that this is a much lower ratio versus what we observed from Amazon, which had a quick ratio of 0.86. In other words, Amazon would be viewed as more liquid than Walmart from this perspective. Hi, in this section, we'll go through the scorecard for the liquidity ratios for Amazon and Walmart.